Good afternoon, everyone. Welcome to the Eurosif Policy and Capacity Building webinar dedicated to the European Commission's Omnibus simplification package, which was published on 26th of February. During this session, Eurosif's policy team will present and analyze the key challenges that have come about as a result of this package and what they mean for the future of the EU Sustainable Finance Framework and for the investment community. The webinar forms part of the Eurosif Policy and Capacity Building quarterly webinar series, which aim at providing an overview of the recent EU sustainable finance policy developments and explaining consequences for sustainable finance market practitioners and help develop capacity to engage in a constructive manner on EU sustainable finance topics. These webinars are typically an exclusive benefit for Eurosif member SIFs, so the members of the national SIFs that are part of Eurosif, as well as the Eurosif Club partners. However, due to a popular demand and international interest in this topic, this webinar has been exceptionally open to a bit wider network of participants. For those of you who are not familiar with our organization, the European Sustainable Investment Forum, in short Eurosif, is a Brussels-based European association promoting sustainable finance at EU level. We strive for a regulatory framework which is conducive to scaling up investments for a just transition to a sustainable and competitive economy. In our membership, we have Europe's based national sustainable investment fora. Most of our members have a broad and diverse membership, including asset managers, institutional investors, index providers, and ESG research and analytics providers. Together with our members, we are committed to the growth and integrity of meaningful sustainable investment flows. Eurosif is also a founding member of the Global Sustainable Investment Alliance, GSIA, where members include SIFs from across the globe, including US, Canada, Australia, and New Zealand, Japan, and UK. Our small but very effective team based in Brussels will today unpack for you the so-called Omnibus proposal, which was published by the European Commission, as mentioned already, on 26th of February, and which suggests significant changes to the Corporate Sustainability Reporting Directive, the Corporate Sustainability Due Diligence Directive, and the EU Taxonomy. In terms of the housekeeping rules, we like these sessions to be interactive, therefore we invite you to ask questions and share your reflections. However, given the number of participants, we invite you to do so via the meeting chat or by raising the hand button. Please make sure to introduce yourself and your organization. Please note that the webinar will be recorded and shared with the registered participants after the meeting. Thank you very much, and with that, I hand over to my colleague Pierre.
Many thanks, Alexandra, and hello, everyone. Happy to see that there is a lot of interest for this webinar today, focusing on the Omnibus Simplification Initiative. So today we will focus on this simplification package, unpacking what is included in this initiative and the potential consequences for investors specifically. As well as highlighting the next steps in terms of process and discussion within the European institutions. We will also use this opportunity to present a summary of the key initiatives that were also published by the European Commission recently and that are linked to this simplification omnibus, so the Clean Industrial Deal, and another initiative on investment simplification, so another omnibus, but we will explain this more in detail later on. We will also tackle some additional topics in a third AUP section. So maybe let's start with this update on the omnibus simplification package, which in the EU jargon means that this is a single legislative text that amends several other EU rules. So what's concretely in this simplification package is our amendments to the Corporate Sustainability Reporting Directive and the Corporate Sustainability Due Diligence Directive, which are pieces of regulation that were adopted recently by the European Commission. The changes to these two pieces of legislation are separated into two distinct legislative texts. One that focuses on the dates of application of CSRD and CSDDD, and a second one that focuses on the content of those modifications. We'll see that this is important because those have to be discussed by the European Parliament and the EU member states. And the European Commission decided to separate those in two to ensure that the initiative focusing on the dates of application would be fast-tracked within European institutions so that it stops the clock, stops the application of these rules, while more detailed discussions can focus on the content of these changes. So it's important to understand this in terms of the next steps and process within the European institution. There are also within this first Omnibus, or Omnibus 1, as it is now called by the European Commission, adjustments to the delegated acts of the EU taxonomy regulation. Important to mention that there are no direct changes from the European Commission to the level 1 or the text of the EU taxonomy regulation itself, meaning that the EU taxonomy regulation will not be rediscussed in the European Parliament and by EU member states, contrarily as what is currently happening with the CSRD and CSDDD. So those targeted amendments were published by the European Commission and are now open for a public feedback period, which will last 4 weeks with a deadline now on the 26th of March 2025. Following this, those adjustments will be adopted by the European Commission and will be scrutinized as well by the EU co-legislators. So those changes target the disclosure delegated acts, so setting the rules for EU taxonomy disclosure rules, as well as the delegated acts that focus on the technical screening criteria for the climate and wider environmental objectives of the EU taxonomy regulation. Included as well in this package are amendments to the Carbon Border Adjustment Mechanism, CBAM, which I'm highlighting here, but given that Eurosif does not follow this topic, we will not go into the details of the amendments that are proposed on this specific file. Let's now focus on the next slide and identify the adjustments to the CSRD, the Corporate Sustainability Reporting Directive. So one thing to mention as well is that there were a lot of, I'm sorry, I can see that there's issues with the sound quality. Apparently not. So let's resume. Hopefully the sound is okay for everyone. So in terms of CSRD, as I was mentioning, so there were a lot of discussions and a lot of fears that fundamental aspects of the CSRD would be removed. So including the double materiality, so financial materiality, but also reporting requirements focusing on the sustainability impact of economic activities of companies, of economic activities within this scope, and the coverage of environmental, social, and governance topic. As CSRD focuses on those three broad areas. So this was maintained in the regulation, but we will see in the directive, but we will see that this still may be in jeopardy given the upcoming discussions in the European Parliament and the Council of the European Union. In terms of the application timeline, as I was mentioning, there is a stop the clock proposal by the European Commission to delay the upcoming deadline for reporting under CSRD. So the next two reporting waves, so the one where reporting in 2026 for this financial year and the one for reporting in 2027 for the financial year 2026, will, or at least the European Commission proposes to postpone those by 2 additional years each. That will give time for EU co-legislator to discuss the content of the changes before it is actually applicable to the upcoming batches of reporting. The scope of CSRD has been significantly changed. It has been reduced by 80%, and it will now focus only on companies with more than 1,000 staff and either a turnover above 50 million euros or a balance sheet above 25 million euros. Under this scope, reporting would be made entirely voluntary following the EFRAG's proposal for voluntary SME. So we will focus on that a bit later. Just to give you a broad idea, this VSME is a developed, or I would say an advanced questionnaire that was developed by EFRAG originally to cover companies under 250 staff and that were not listed. So we will see that it is not, unfortunately, seem to be fit for purpose for companies that are under 1,000 staff. The VSME is also related to a value chain cap, meaning that companies that are under the scope of this updated CSRD cannot ask smaller companies in the value chain for additional information compared to what's included in the VSME. What that means is that so if you are in the value chain of a bigger company, then you don't have to produce those information. In terms of assurance as well, CSRD was planning to require companies under scope to start with limited assurance and then upgrade over time to reasonable assurance requirements. But this requirement has been deleted from the Commission proposals, which means that limited assurance will remain as the only required assurance approach under CSRD. Then again, if these proposals are maintained following interinstitutional discussions. And the European Commission will issue EU-specific guidelines on assurance instead of standards as it was originally planned in the main text of CSRD. I see we have a question from Malen already, so maybe you can we can allow your mic, Marlene, and you can ask your question. Or you can also put it in the chat if your mic doesn't work. So I will continue the presentation and maybe Marlene, you can ask your question in the chat. So on the ESRS now, so the sustainability standards under which the CSRD disclosures had to be conducted. There are also some significant changes that are proposed by the European Commission. So first, the European Commission was supposed to adopt sector-specific sustainability reporting standards to be prepared by EFRAG, its advisory group on these sustainability standards. And these were supposed to be adopted by June 2026. The European Commission proposal to modify CSRD now deletes the notion of these sector standards, meaning that these would not have to be adopted and would not be implemented. The European Commission is also mentioning that it has plans to bring adjustments to the currently applicable ESRS, or also called ESRS Set 1, which were adopted by the European Commission in July 2023. They plan to bring substantial reductions in terms of the number of data points. They also aim to clarify key terms within those ESRS. And there is also a goal to simplify structure and presentation of the standards. One thing to be mentioned is that we don't know the exact content of these changes because this is still in preparation by the European Commission. We do know that EFRAG will be involved in the process of establishing these different changes, and will look at ways to simplify the SRS this year for the European Commission to adopt those changes. But we will look at the exact timeline and process in a few minutes. In terms of the VSME standards, so the voluntary standards that could be applied on a voluntary basis by companies that would not be under the updated scope of CSRD, the European Commission will issue soon, there again, no precise timeline, a recommendation on the VSME, and plans on the basis of those VSME standards to adopt a delegated act under the CSRD, which means that these VSME standards will have regulatory aspect to them, contrarily to what is currently the case with the VSME, where it's not embedded in the text in EU regulations. So that will give regulatory backing to those standards. I think we can now go to the next slide, focusing this time on CSDDD, and I think that Anne will cover this part.
Thanks, Pierre, and welcome also from my side. So on the CSDDD, so the Corporate Sustainability Due Diligence Directive, there are also significant changes proposed by the European Commission. So the first one is once again the application deadline, this time a delay of the first phase of application by 1 year. Now it would be 2028. Then very much one of the core aspects of the CSDDD, the civil liability for the harm a company is causing, would be removed from this EU law, and instead this would fall back to the national legislations, what kind of rules would apply. Then on due diligence, it would narrow the scope of what is being covered by this law. So in the current form, it's the entire supply chain in both directions, upstream and downstream. And this would now be significantly cut to only the direct suppliers, or tier 1 as it's called. Also, the definition of stakeholders that you have to take into account would be reduced to only those that are directly impacted. This obligation of doing this due diligence process would also be reduced to only once in every 5 years, rather than the ongoing obligation it was before. Also, there was in the original draft a review clause for the financial sector inclusion. So in the version that's out right now, the original, there is a potential to look again in 2 years if the investments of financial institutions should be covered under CSDDD. But this potential has now been definite, or if this goes through, it would have been completely cut. So financial sector downstream due diligence would be excluded. Then also an important change on the climate transition plans. At the moment, companies have to adopt and put into effect these climate transition plans, and this put into effect would be cut. So there's now the question if, in theory, you could adopt a plan but then not act on it, if that would still qualify as CSDDD compliant. Also, when it comes to penalties for not complying to those rules, in the original version, there was a rule of at least 5% of net worldwide turnover for the penalties, which has been removed. Also, national authorities or national legislators have now a limit. They can't do more than what the CSDDD is asking for, so no gold plating. And there is an SME shield. So larger companies cannot ask companies in their value chains with less than 500 employees for more information than what would be covered in EFRAG's VSME standards. So only a very limited set of information, which is also a bit inconsistent with the similar rule in the Omnibus proposal for CSRD, where this is for 1,000 employees and not 500. Are there any questions on this, or I'll give the floor back to Pierre.
Doesn't seem to be any questions specifically, and I think so. The next slide would actually answer some of the questions that I've seen in the chat. So first, I think we are going to discuss the changes to the proposed changes to the taxonomy in the next slide. There you go. So regarding the EU taxonomy, so as I mentioned a few slides ago, there is no modification to the actual taxonomy regulation per se, but the EU taxonomy shares its scope for disclosure requirements with the CSRD. What that means is that the reduction in scope of the CSRD also impacts the scope of taxonomy disclosure requirements. So there is also a significant reduction of EU taxonomy disclosure requirements, and there is also an additional top-up requirements for full taxonomy reporting regime of so the 1,000 employees as also established by CSRD, but also a top-up of 450 million net turnover. What that means concretely is that there would be 3 different regimes for taxonomy reporting. Companies under 1,000 employees will not have to report under the regime. Company with more than 1,000 employees and with a net turnover not exceeding this 450 million threshold could use a new opt-in regime if they want to claim that they are taxonomy aligned, and here they would benefit from some fully voluntary features. For example, disclosure of OPEX alignment would be made fully voluntary, and the option to report partial alignment with the EU taxonomy as well. Other proposals from the European Commission are, however, limited to targeted changes to delegated acts, with there again some amendments and adjustments in the delay of reporting. Some changes in the reporting templates under the EU taxonomy, with a deletion of about 70% of required data points. The introduction also of a materiality threshold, which limits reporting to activity that constitutes more than 10% of total revenue CapEx or OPEX. Some also changes to the green asset ratio denominator, which will now exclude companies that are not covered by the new scope of CSRD, so exclude any company with less than 1,000 staff and 50 million turnover or 25 million of balance sheet. And there is also some proposals to simplify the do no significant harm criteria for the specific objective of pollution prevention and control as well. So on the next slide, now we will focus a bit more on the potential consequences for investors. So first, let's keep in mind again that these are proposals by the European Commission. What that means is the changes to CSRD and CSDDD in particular will have to be discussed by the European Parliament and EU member states. What that means is that now that the texts are reopened, there can be any amendments to these proposals by MEPs and member states. So potentially, these changes can be, or these proposals can be either reverted or made actually more stringent. Here, we still have no clear idea of the different balance of proposals within, for example, the European Parliament. But let's just say that now that these texts are reopened, any kind of amendment can be applied to these proposals. So keeping that in mind and focusing only on these initial European Commission proposals, What that would mean is, so in relation with CSRD in particular, a fairly important limitation in the data availability and comparability for investors. So the reduction of the scope by more than 80% will result in only about 7,000 companies remaining under scope, which would be even less than pre-CSRD rules. So the predecessor of the CSRD, the non-financial reporting directive, had a scope that focused on companies above 500 employees, so 11,000 companies. And that would obviously drastically reduce the current CSRD scope, which is of about 43,000 companies. The deletion of sector-specific standards is also likely to reduce the availability of sector-specific decision useful information for companies. And there again, the idea of these sector-specific standards were not necessarily to add additional requirements for sector-specific companies, but to clarify how the ESRS were supposed to be applied and clarify the information and make it more tailored to those different specific sectors. This all may result in an increased reliance by investors on data questionnaires and estimates or data providers for the companies that are not included in the scope of CSRD. Significant issue that we flag as well in terms of those companies that could still, conduct some voluntary reporting using the VSME, if not in the scope of CSRD, is the fact that this VSME does not really seem fit for purpose for this objective. So firstly, it was designed with companies having less than 250 employees, not listed. And so its structure is completely different from the way the ESRS Set 1 and other international standards for that matter are organized. It's organized with different modules that with the basic modules and additional modules that can be built on top. So in terms of comparability with the ESRS, this might make things a bit more difficult for investors. It's also important to mention that the VSME is not a properly established standard per se. It's, as I mentioned, a more detailed or more standardized questionnaire, but it has none of the requirements that the standard ESRS ask from companies. So no double materiality assessments, no audits or mandatory audit, at least of the published information. It lacks also a full coverage of what ESRS can provide. So for example, while some indicators and the mandatory ones under SFDR, so those are included in the VSME, but that's not the case for all the other additional indicators under SFDR, for example, that could be included. That could be, used in designing financial products. And for some specific information as well. So there is still some leeway given to companies, which means that information on specific topics, for example, scope 3 emission, would potentially not be presented in the same way depending on the company, making comparability a bit more difficult then again. One key issue that investors could have as well is this value chain cap. So this, of course, remains to be clarified, given that's the European Commission proposal in this instance is not completely clear. But potentially, given that investee companies are considered to be in the value chain of investors, the value chain cap could prevent investors from asking any additional information beyond what is included in VSME for companies that is not included in CSRD scope. So we see that as a key issue that would restrain the capacity for investor to ask for additional information for a large part of those the EU companies. We can go maybe to the next slide. So of course, the reduction in the scope of the taxonomy is also impacting investors. That would mean, by definition, less companies that report against taxonomy alignments, meaning less possibility for investors to use taxonomy alignments at portfolio level. We also see a few issues with some of the proposals in the European Commission's suggestions. So, for example, the 10% materiality threshold may de facto exempt from taxonomy reporting huge companies that are significantly diversified. So that may mean that even some of the largest companies may not be included in those disclosure requirements. There are also some proposals that remain to be specified by the European Commission. So typically, what partial taxonomy alignment means is still yet to be defined. Then again, as Anne mentioned, under CSDDD, key requirements was the requirement for companies under scope to adopt, but also to put into effect climate transition plans, which was a slightly lighter version of an obligation to implement. Now that this has been rewarded, we could interpret that new implementing measures that is included in the CSDDD as a way for companies to not have to implement those transition plans. And that would then again lead to less availability of credible transition plans and credible forward-looking data for investors to use those at portfolio level. As I mentioned as well, the deletion of a potential extension of the CSDDD to financial institutions or financial services would mean that there would be no due diligence requirements for financial institutions. And so finally, one also potential consequences that we see taking a step back and looking also at the other EU regulations is the impact of this, reduction in the data availability for other EU rules that necessitate this information. So typically the SFDR review, which is now postponed to Q4 2025, will have to take into account the discussions on the Omnibus and the potential issues in data availability and changes in CSRD in particular. So now responding to some of the questions that I've seen in the chat and that I mentioned also a few minutes ago, we are still uncertain whether these changes will actually be the ones that are included in the final texts. The changes to CSRD and CSDDD will have to be discussed in the European Parliament and by EU member states. And while we know that for this stop the clock proposal, discussions are likely to go very fast to suspend the implication of these rules while we assess and modify their contents, the discussion on the content themselves are likely to take more time. And here there is no clear timeline envisaged, especially in the European Parliament. Discussions can lead to wide variety of outcome on the content and can take some time as well. So in terms of timeline and exact content, we don't have a clear visibility on the final product, I would say, yet. So on the next slide, we will probably just mention a few of the next steps. So as I mentioned, the two proposals on the CSRD and CSDDD will follow two different parallel track. The stop the clock one is expected to go relatively fast, while the other one will be properly discussed. On the European sustainability reporting standards, so we know that to follow up on this willingness of the European Commission to simplify significantly the data points and structure of the ESRS set 1, we know that EFRAG will be mobilized to come up with proposals this year, and that the European Commission will adopt, modify potentially, and then adopt those proposal at the latest 6 months after the adoption of the final text of the modified CSRD, meaning that will be 6 months after the CSRD is discussed within the European Parliament and the EU member states, that they negotiate a final compromise text, and that it is actually clear what shape the final text has. So this will also take some time. The European Commission, as I mentioned, is also willing to adopt delegated acts to the CSRD based on the VSME prepared by EFRAG. So on this, the European Commission doesn't have to consult EFRAG and can adopt those with a timeline that is still yet to be specified. So the process on this is relatively unclear, but we know that at least as a first step, the European Commission will publish a recommendation on voluntary reporting. A recommendation is not a legislative text per se, so that will just be sort of guidance from the European Commission for voluntary reporting. So for the EU taxonomy as well, so as I mentioned, there are no changes to the level 1 or the text of the regulation itself, but there are some proposals to the delegated acts. We are now subject to an open consultation, deadline on 26 March 2025. And so following this public consultation, the European Commission will consider this input and adopt the modified version of these delegated acts in the second quarter of 2025. So we understand that the Commission really wants to go also quite fast on those changes. And with a 2-month scrutiny period from EU co-legislators. So when a delegated act is adopted by the European Commission, the European Parliament and EU member states generally have a 2 or 3 months period to scrutinize these proposals and approve those or reject those. What that means is if everything goes smoothly and the EU co-legislators do not oppose the changes that are proposed by the European Commission, we could see those being applied or at least enter into force quite quickly, even in 2026. But this, again, is still to be seen. If the EU co-legislators see an issue with the Commission proposal and oppose those adopted delegated acts, then the process can be, of course, much longer. Just before maybe I have a look at the different questions, as I see that there has been a lot of questions in there. We just wanted to flag what Eurosif did in the build-up to this publication. So first, we of course talk regularly with EU co-legislators, with the European Commission, with the European Parliament and EU member states, and we tried to ensure that the voice of responsible investors were considered in those discussions. So on the 4th of February, we published a very well-received joint investor statement in collaboration with IGCC and PRI, which focused on ensuring or on asking the European Commission to avoid bringing substantial changes to those regulations, highlighting the need for investors to have regulatory certainty, as well as having the necessary sustainability data to comply with their own reporting requirements, but also to design their own investments and be able to make informed investment decisions. We also participated to some behind closed doors stakeholder roundtables with the European Commission, also on behalf of IGCC and PRI, on the basis of that joint statement. And so in the coming months and years, we will continue to advocate in the different steps of these proposals on this Omnibus 1 initiative. So what I would ask of you, of course, if you share some of the concerns that we expressed today on the Omnibus, feel free to share those with your respective SIFs or directly with us. And feel free also to provide us with evidence of those issues that you could see so that we can make evidence-based positions on that basis and be more impactful towards European decision makers to ensure, then again, that these rules in the end are also adapted to the needs of investors. So now what I suggest is that Anne, you continue on the next part of our presentation today. And in the meantime, I will look at your different questions in the chat and I will try to answer those.
Okay, thanks, Pierre. So the next part is about two initiatives that were published by the European Commission on the same day as the Omnibus. And these are not files that we're directly working on, but they're still relevant on the one hand because they concern sustainable investment, and on the other hand because they really show the general direction and the context that the Commission is working in. So one is the Clean Industrial Deal. This is a communication where the European Commission lays down its plans to combine sustainability and economic concerns to make the EU more competitive. So the idea is to mobilize investments to decarbonize energy-intensive industries and scaling up the clean tech sector. So this has several intermediate goals, for example, reducing the cost of energy, increasing the demand for clean products, obviously mobilizing investment and channeling it towards these industries. Also things like securing access to the critical raw materials you need for example, the tech sector, and improving education and training. By the way, I've linked an overview document in the slide, so when we send it to you, you can have a look. The main initiatives include, for example, an Industrial Decarbonization Accelerator Act, which they still want to finish this year. So this will concern initiatives for energy, industrial decarbonization, boost the aforementioned demand for clean products in the EU, taking care of resilience, for example. Then also on the topic of investment for these industries, they are trying to make EU-level funding more attractive, for example, by establishing an industrial decarbonization bank, and are trying to leverage private investment and also provide public investment for those goals. I will go into more detail on the InvestEU program in the next slide. What they also want to do is sectoral transition pathways to develop in the coming months. And they want to first focus on automotive, steel, and the metal sector, which they are apparently planning to adopt pretty soon this month. And then there's also the Omnibus 2. So Omnibus 1 is the main initiative we talked about so far. And then there's also a second Omnibus, which also modifies different laws at the same time. But this is a relatively focused one. It concerns the InvestEU program, which intends to mobilize investment for goals in line with the EU priorities, which is, for example, sustainable industry, digitization, and so on. And here the proposals include increasing the financial guarantee provided by InvestEU to make it more attractive for private finance. Also, there are several rules that are made more flexible. So now you can combine it with other EU financial instruments. Member states have more flexibility. And also, so we kind of see the topic of simplifications again, a reduced regime for smaller companies that receive these funds, less reporting, and so on. So what we found striking, if we compare these two initiatives with the Omnibus 1, is that on the one hand, the EU really wants to channel investment towards a sustainable transition, but we are worried that at the same time with the proposals of the Omnibus 1, we lose, for example, very important data points. So are there any questions on this part? Or Pierre, do you want to answer the questions from before now?
I think I'm going to respond to the questions in written form in the chat.
Okay,
So,
then I'm going to continue with the AUB. Okay.
sure.
So first, we want to introduce an initiative from our side, which is maybe especially relevant in the current political context. We've launched it in January, and it's an opportunity for companies to become more closely involved with our work at Eurosif, also to network among each other and to bring in their expertise for a more sustainable, implementable, practical EU sustainable finance framework, but also benefit from our policy insights. It has three main areas. So one is EU advocacy and policy, then information and regulatory intelligence, and events networking and visibility. On the EU advocacy and policy side, if you would become a Eurosif Club partner as a company from the sustainable investment chain anywhere in the market, so it could be an investor, but also a data provider, for example, you could become a member of our advisory groups, where we come together regularly via video call and discuss current political EU developments with relation to sustainable finance. So, for example, at the moment we have one on SFDR, and we can develop more based on the needs. So companies can share the insights from the market, learn what we found out at the EU level, and this would help inform our positions to advocate for a better EU sustainable finance framework. Then companies that are Eurosif Club partners would also receive information documents regularly. So, for example, each month we share a legislative tracker, at the moment only to our members, but Eurosif Club partners would also receive it, which is a sort of cheat sheet document where you have a lot of information about the files that are relevant for sustainable finance in one place, all the links, all the developments. Also a regulatory timeline, what comes when, and also a newsletter at the moment for members, but also for Eurosif Club partners, where we add more policy insights than what you can find in the public version, so a bit more analysis. Then we will organize quarterly discussion calls where you can network, and also an annual event here in Brussels, where you can connect with each other, but also with Eurosif, with EU policymakers. There are also some things that might be interesting for you if you'd like to have a bit more visibility in the sustainable finance context. Eurosif Club partners would be displayed on our website. And you can also use the Eurosif Club logo on your own website. And you will get discounts on sponsorship packages. So as you might know, we have a pretty active LinkedIn with more than 30,000 followers. So you could have tagged social media posts there. We also have a podcast where we could do a sponsored interview or some items in our monthly newsletter, if that's of interest to you. On the practical side, so it's open to investors, but also other companies active in the sustainable finance and investment markets. There's one main condition, that's if you are in a country where you have a national SIF that is a member of ours, which of course many of you probably are, otherwise you wouldn't be here, but not everyone, then you would first need to be a member of that SIF, and then on top of it, you can become a Eurosif Club member. If you are in a country where we don't have a member, for example, Norway or the Netherlands, then you can join us directly. All you need to do is fill in an application form and send it to us. You can find more information on our website, which is also linked in the slides that we will share with you. Thank you very much. And I'll give the floor back to Pierre.
Yes. Thank you, Anne. And maybe as an example of the things that we do in the Brussels space, we are organizing jointly with the EPP group of the European Parliament next week a panel discussion on financing sustainable growth in the EU, next steps for competitiveness and industrial decarbonization agenda. So that would be next Wednesday, 19th March, with a very nice panel of speakers with MEP Radan Kanev, who will be the host of this discussion, but also Lara Wolters, who is the rapporteur for the CS-DDD proposals and was also involved in the discussions on CSRD. Martin Merlin, who is the Director for Financial Markets at the European Commission. But we will also have practitioners, Matt Christensen from Allianz Global Investors and Jesus Martinez from the Iberdrola Group participating, as well as Elena Viñez Fiestas, who is chairing the Platform on Sustainable Finance, who is this advisory group to the European Commission focusing more specifically on the taxonomy and the different regulatory standards and tools that are aiming at developing sustainable investments in the EU. And discussions will obviously be introduced by the chair of Eurosif, Nathalie Deniez. So just to mention that due to very limited room capacity and the fact that this event will be in the European Parliament in Brussels, we have restricted in-person participation to MEPs and EU decision makers. However, registration for online participation will be open soon and will be shared with all the participants to this webinar so that you can join in and listen to what those different panelists will have to say. And obviously, even though the scope of this event is quite general, we will have some discussions on the Omnibus, and all the different speakers will be able to share their perspective on this simplification effort. So maybe just to finalize, on the Omnibus itself and responding to some of the questions in the chat. So we are still internally at Eurosif conducting a more detailed analysis of the European Commission proposals. So there are some large questions that are in the chat that we cannot answer. For example, the extraterritoriality. This is not something that we had a look in detail. So unfortunately, we can't give you more precision for now. Some questions on how things are going to apply in practice if the Commission proposals are retained in the final text. Well, these are very good questions, obviously, and this is for some aspects of these proposals unclear to us. For example, typically the value cap between CSRD and CS-DDD is not the same. Under CSRD, it is for companies under 1,000 employees. Under CS-DDD, it would be for companies under 500 employees. And how this would work in practice for investors and also for larger companies requiring additional information from their value chain partners. This, for now, we don't know. This will have to be specified during the discussions as well. Then I've seen a few questions on transition plans as well. So just to highlight, because I've seen a few questions on that, that's what has been changed in CS-DDD is the requirement to implement transition plans and not necessarily to adopt transition plans. And there, for now, there has been no change on the content of transition plans that is expected under the ESRS. This may be modified when the European Commission adopts its different changes to the ESRS that are planned. But for now, the requirements for the content of transition plan stay the same, and they are consistent between CSRD and CS-DDD. Same for some questions of how are financial institutions expected to apply the 10% materiality threshold. There again, it's quite difficult to see and to analyze in detail how it could work in practice. We'll probably have to listen to practitioners on how it could be possible. For now, it's not really specified by the European Commission. I've seen also questions on the effect on profitability that the reduced available data will mean. and risk of reduced availability of data for risk management. That's also one of the things that is quite difficult to quantify. A reduction of 80% in the scope of those different regulations will, of course, impact probably negatively the availability for investors to conduct those different exercises. Yes, and we are also, obviously, as I was mentioning, we are working on our own, establishing our own positions, and we are working on the VSME and data points, on also establishing proposals as alternatives for VSMEs, which, as we just mentioned, we consider not being fit for purpose for the larger companies that are not included in this updated CSRD scope. So this is still work in progress, of course, but we will come up with those proposals in a few months. So I think that I covered pretty much everything. So thank you for your very active participation in the chat. Apologies for some of you who had some sound issues. It seems that the majority of participants had a fine experience. Hopefully, I responded to most of the questions here. If you have, of course, additional information needs, feel free to reach out to your SIF or to us directly. And for now, I'm thanking you all for your participation, and we'll also flag that we will continue those webinars across 2025, and so then we'll circulate the date of the next one through your respective SIFs as well in the coming weeks. Thank you, everyone. Bye.
Thank you.